Okay, so the purpose of this narrated slideshow is to just kind of give you all an overview, maybe not going into super in-depth into the concepts in this chapter that you'll be looking at. It's not necessarily intended to replace reading the chapter. You know, if you have some familiarity with these concepts already, and you know, after looking at the narrated slideshow, you're comfortable enough with the material to move forward into the homework and quiz, you know, I don't have a problem with that. Obviously, you know, any way you can learn it is fine with me. My suggestion would be to watch the slideshow, read the chapter, watch the outline or the presentation of me walking through some problems, and then start walking through the problems yourself. Okay, so cash flows. First objective is to identify the purposes of the statement of cash flows and distinguish among the various categories in the statement of cash flows, which are operating, investing, and financing cash flows. The statement of cash flows was developed to provide users of financial statements information regarding the sources and uses of cash during the fiscal period. The statement allows the user to determine why cash increased or decreased during that period. So for example, did we sell a lot of product during the period? Did we borrow money? Did we sell off some of our equipment that we no longer needed or that was becoming obsolete? So the statement helps to predict future cash flows and helps with the planning of how future cash flows will affect the entity. Now, all cash flows can be assigned to one of three different categories, and these are the categories you see on the statement. Cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Cash flows from operating activities include cash inflows and outflows related to revenue and expense activities. Items such as cash received from customers, wages that were paid, interest payments, income tax payments, and cash paid for some service like advertising would appear. Now, cash flows from investing activities include cash flows related to changes in long-term assets. For example, if we purchase a building or some new equipment, we record cash outflows or money spent relating to those investing activities. Also, if we buy equity investments in other companies, so stock in another company, for instance, that would be considered an investing activity cash outflow. On the other hand, when we sell land or equipment, or sell off an investment that we purchased in some other company's stock, we would record cash inflows related to investing activities. Cash flows from financing activities include cash receipts and disbursements that are related to increases and decreases in long-term liabilities and equity. For example, financing cash flow activities would include borrowing money from the bank, paying a dividend to shareholders or stockholders, and raising capital for the entity by selling some of our own stock or issuing new stock. So these next two slides shows a summary of the various categories that make up the statement of cash flows and some examples there, operating activities, and then financing activities. And then a separate schedule that includes investing and financing activities that do not include cash would be the non-cash investing and financing activities. Now, there are two formats for preparing the statement of cash flows that are allowed under GAAP, or generally accepted accounting principles. First, you have the indirect method, and then you have the direct method. Although FASB, or the Financial Accounting Standards Board, considers the direct method to be a more theoretically sound approach, the indirect method provides the same overall results, but is has the advantage of being much easier to prepare. Under the indirect method, you start with the accrual net income, then make adjustments to the net income to arrive at a cash income number. Under the direct method, we will restate the income statement as cash receipts and disbursements. This method will show actual cash receipts and cash disbursements related to the income generating process. So now we have an opportunity for you to take a look at some examples and try to determine whether you think each of these is an item that would fall under the operating category of the statement of cash flows, the investing category of the statement of cash flows, the financing category of the statement of cash flows, or whether it would be considered a non-cash financing or investment transaction. So first of all, we've got cash receipt from the sale of equipment. So that should be pretty easy for you as an investing activity because we said that under that category you have the buying or selling of equipment. Cash payment for salaries. Again, this one shouldn't be too difficult. Generally, salaries are tied to the operating activities of the industry. So this one would be a cash outflow for operating activities. Cash receipt from notes receivable, again, is going to be a investing activity, a cash inflow from an investing activity. Purchase of equipment in exchange for notes payable. You'll notice here that this is a transaction that doesn't involve any cash at all. It's the only one of these examples that doesn't have cash in the name. So pretty good guess or pretty good bet would be that this one is non-cash. And then finally, we have cash receipt from the issuance of common stock. Again, we said that when we issue our own common stock, this is an example of a financing activity where we're generating capital. So you would put an F there. Okay. Our next learning objective is actually preparing the statement of cash flows by using the indirect method. The FASB, or again, the Financial Accounting Standards Board, allows two different approaches to be used for the preparation of the statement of cash flows. Again, we have the direct method and the indirect method. The direct method is FASB's preferred approach, but like we said, since the indirect method is more simple or more easy to put together, it ends up being the one that's used by over 90% of companies that are required to prepare GAAP-based or generally accepted accounting principles-based financial statements. The only real difference between the direct method and the indirect method is the way in which cash flows from operating activities is determined. Now, to prepare the statement of cash flows using the indirect method, you need 5 pieces of information. First, you need the income statement for the current period. Second, you need the balance sheet for the beginning of the current period. Third, you need the balance sheet for the end of the current period. And this, second and third is so you can track the differences between the beginning and ending balances on the balance sheets. Fourth, all of the changes in long-term assets during the period. And fifth, all the changes in long-term liabilities and equity during the period. Now, the actual computation of cash flows from operating activities is generated using the following equation. Net income plus non-cash expenses plus accounting losses minus accounting gains plus or minus changes in current assets and current liabilities. Now here you see in Exhibit 16.6 how changes in different items impact the cash flows from operating activities. As we talked about, we always start with net income or loss, and then we're going to add back all non-cash expenses to the net income. Expenses such as depreciation expense, amortization expense, depletion expense. These are examples of expenses that are not related to current cash flows. Next, we're going to subtract accounting gains from net income. These gains, such as gain on sale of land, are not cash flows that are related to operating activities, so their effect should be eliminated from net income. Third, we're going to add accounting losses back to net income. These losses, such as loss on sale of equipment, are not cash flows that are related to operating activities, so their effect should be eliminated from net income. Fourth, when current assets increase, we will treat that as a use of cash and subtract it from net income. Fifth, when current assets decrease, we will treat that as a source of cash and add it to net income. Sixth, when current liabilities increase, we will treat that as a source of cash and add the increase to net income. And seventh, when current liabilities decrease, we will treat that as a use of cash and we will subtract the decrease from net income. If we want to see how cash flows from operating activities works with numbers, let's look at this example of Smart Touch Learning. Assume that Smart Touch Learning's net income for the period was $40,000. We will put that in our starting slot for this computation. If Smart Touch Learning has depreciation expense of $20,000, we will treat that as a non-cash expense and simply add that to net income. Smart Touch Learning has no losses during the period, but they do have a $10,000 gain from selling plant assets. The $10,000 will be subtracted from. Smart Touch Learning's inventory decreased during the year by $2,000. The change will need to be added to net income. In addition, since accounts receivable increased by $17,000 during the year, that change will have to be subtracted from net income since it does represent an increase in non-cash sales. Smart Touch Learning's accounts payable increased during the year by $40,000. The change will need to be added to net income. Accrued liabilities decreased by $5,000 during the year. This change will have to be subtracted from net income. When all of the adjustments have been made to net income, you'll be able to compute net cash flow from operating activities. Exhibit 16.5 shows how the cash flows from operating activities section might appear on Smart Touch Learning's statement of cash flow. With respect to investing activities, Smart Touch Learning's records show that $310,000 in cash was spent on new plant assets during 2015. The $10,000 gain on the income statement resulted from selling fixed assets originally costing $55,000 and having accumulated depreciation of $15,000 for $50,000. Exhibit 16.5 shows the cash flows from investing activities section. Smart Touch Learning shows cash flows from investing activities of $310,000 and cash inflows from investing activities of $50,000. With respect to financing activities, Smart Touch Learning's records show inflows from investing activities of $90,000 borrowed on a note payable and $120,000 received from the issuance of common stock. Cash outflows from investing activities included $10,000 paid to retire old notes. $20,000 was paid to acquire treasury stock, and $10,000 in dividends were paid. Exhibit 16.5 shows cash flows from financing activities of $170,000. Smart Touch Learning's net decrease in cash for the year is $20,000. We arrive at this by combining the net cash provided by operating activities of $70,000, the net cash used by investing activities of $260,000, and net cash provided by financing activities of $170,000. When we add the balance in cash at December 31st, 2014 of $42,000, we have a cash balance at December 31st, 2015 of $22,000, which matches the cash balance on the December 31st, 2015 balance sheet. Using the amounts shown for OWL Inc. at December 31st, 2015, Prepare Al's statement of cash flows using the indirect method. Assume that cash at December 31st, 2014 was $12,000 and cash at December 31st, 2015 is $75,000. Cash flows from operating activities starts with net income of $30,000. Add back depreciation expense of $12,000, the decrease in current assets of $8,000, and the increase in current liabilities of $10,000. Cash flows from investing activities shows a $20,000 increase in cash provided by the disposal of equipment and a $25,000 decrease in cash resulting from the acquisition of land. Cash flows from financing activities shows a $12,000 increase in cash resulting from the issuance of common stock and a $4,000 decrease in cash resulting from the payment of dividends. The resulting net increase in cash of $63,000 is added to the beginning cash balance of $12,000 to arrive at the ending cash balance of $75,000. Our next learning objective is to be able to use free cash flow to evaluate business performance. Free cash flow is a measure used to assess the amount of cash available for unexpected opportunities. The amount is determined by starting with net cash from operating activities and deducting cash payments planned for investments in long-term assets. Smart Touch Learning expects $200,000 in operating cash flow. Their plans are to spend $160,000 to modernize their product facilities and to pay $15,000 in dividends. So you have $200,000 minus $160,000 minus $15,000 equals $25,000 left over of free cash flow. Calapono Company expects the net cash from operating activities in 2014 of $100,000. Net cash used for investing activities is expected to be $20,000, and cash dividends for 2014 will be $2,000. How much free cash flow does Calapono expect in 2014? So our equation is free cash flow equals $100,000 minus $20,000 minus $2,000 for a total free cash flow of $78,000. So basically what's left over after you take the things that are planned out. Next learning objective is to prepare the statement of cash flows by the direct method. Cash flows from operating activities can also be computed using the direct method. Each item on the income statement is converted from an accrual number to a cash basis number. Most of the amounts will be adjusted based on changes in current assets and current liability amounts. Non-cash expenses, losses, and gains will be ignored. Probably the most difficult characteristic of this approach is that the numbers needed for the direct method are not actually directly available in an accrual accounting system. Cash collections from customer is computed by starting with sales revenue. Add back beginning accounts receivable and subtract ending accounts receivable. Cash receipts of interest can be determined by starting with interest revenue and adding beginning interest receivable and subtracting ending interest. Cash receipts of dividends can be determined by starting with dividend revenue, adding beginning dividends receivable and subtracting ending dividends receivable. Cash payments to suppliers can be determined by starting with cost of goods sold, add ending merchandise inventory and beginning accounts payable, then subtract beginning merchandise inventory and ending accounts. Cash payments to employees can be determined by starting with salaries and wages expense and adding beginning salaries and wages payable while subtracting ending salaries and wages payable. Cash payments for taxes and interest can be determined by starting with taxes or interest expense and adding the related beginning payable balance while subtracting the related ending payable balance.